Good morning, traders. It's 8:01 a.m. Chicago time on Thursday, the 25th of February, 2016. This is another Trader Bite, early nourishment for your trading mind. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not indicative of future results. The overall sentiment overnight as an initial indicator. Oil being down 1.34%, now down about 1%. Gold down 0.25%. U.S. Treasury bond futures down 0.09%. 10 years up 0.08%. And Eurozone Treasury futures, the Bund specifically, is down 0.11%. The Nikkei up 1.41, Hang Seng down 1.58, and the Shanghai down 6.4%. Big hit there, especially in their telecom sector. Japanese yen futures down 98 bips, and the Eurozone equities, the DAX is up 1.6%, FTSE down 2.3%, CAC, FTSE's up 2.3%, and the CAC is up 2.2%, with the U.S. equities only being up 0.09%. The U.S. dollar index is up 7 bips. So you can see that there's a mixed bag there. The risk appetite for the overnight session coming into the U.S. Open here is neutral. The market allocation overall is in a holding pattern after yesterday's run up. So not expecting too much out of today's open. We're opening in line with where we closed yesterday. Not much to factor in. The biggest piece of news is China, of course. China's industrial and telecom sectors were hit with an 8% loss. Bloomberg says there's a spike in short-term money market rates, which contributed to the slide. Incidentally, China, in a list that was just released, China now has the highest number of billionaires in the world. China's number of billionaires has exceeded the American counterparts. 568 billionaires in China versus 535 billionaires in the U.S. Bill Gates being the wealthiest man in the world at 80 billion. That's what they say. So let's switch gears and look at the technical picture. This chart, which looks like somebody bled on it, is the daily composite chart. My charts are being modified. I'm working with IRT to improve the layout and the software in general to make it cleaner to look at. But you can see here the latest action is simply a continuation of what we talked about before, which is this W formation with a 40 pivot having been broken to 43.75, and we've had the pullback. The pullback goes to where, just as we talked about yesterday in the Trader Bite, 1890, pushed through by a little bit, down to I think 84, 86. 86, and then it found buyers, pretty strong buyers yesterday, a big rotation up, very solid buying into the close yesterday. The catch was that the buying saw a pretty poor delta on the way up, but overall from this chart you can see that we are still in this balance going back to the beginning of January. We're still trading in the same range we started the year with. And then when I zoom out and pull in this composite, let me push it to the back here. This composite goes from the August low and incorporates everything that we've done since August, this entire range. And the reason I pulled this composite in is to look at what happens once we exceed this 43.75, since we are pretty strong What happens when we exceed the 43.75? What are the next areas to look at? So instead of looking at the composite, which is right here, this black thing is the composite. The composite is all volume at price going back to when the chart started, which is October 9th of 2013. This composite, though, this microcomposite here, just takes in the latest action and gives us a little more definition. By definition, I mean instead of little, you know, little hills, we start to see much more definition in where the volume actually took place in the market, so that we can measure what the next areas are. So we got through this 1940 LVN here. Once we get through the 1940 LVN, we have this CHVN as the next key target. This CHVN is at 64, and that's the next big area up beyond 64. Now you get to this LVN, and notice that these LVNs and HVNs and so forth are not just happening in a vacuum. They account for, if I draw a straight line, which I can't do with this program here. Oh, I just did. If I draw a straight line, you'll notice that the LVNs occur somewhere around the peaks and valleys or highs and lows of certain prices. And not only that, but it's looking inside of these bars, inside of these candles. And if you look inside of these candles, a lot of times you'll see that volume dries up in those areas as well. So you may have a double distribution day with an LVN right against this area. It doesn't matter, because all this profile is doing is it's picking up the volume at price at every single price in the selected bars, and these bars are day session only. So it's important to note that the next area beyond there is 72, the 72.50. So we're looking for 64 above 72.50. Of course, the 50 is the next half century mark. That's very often a key strike zone and an area that the market will likely react in once it gets there. So this is how the big picture is shaping up. It is fairly bullish. So when I zoom out here again, the pattern here is a classic bullish pattern: higher low, pullback. Instead of getting a continuation, normally we'd get a pullback to a maximum of 50% or so, and then we would get the energy to push lower, and we would get a lower low. We did hit the 1810.75 that we talked about. It hit it twice, and we found buyers underneath it. The next target down that I had outlined was way down here in the 1745. That was a key area for the bulls to hold. That was the value, or the valuable price at which bulls can jump in if they still believe that the market's going to make new all-time highs, 2109. And so the market actually jumped in ahead of that. Participants jumped in ahead of that and have pushed it through and are taking out this pivot. Just like with every pivot, we generally push through by a few points, pull back to the high volume area, and we've pulled back to the high volume price outlined in black here at 1890 as mentioned yesterday, and we have pushed off of it. So what was yesterday's plan? Just to make sure we're accountable, right? Yesterday's plan was that the market was opening in a gap. The expectation is the market would start to rotate upwards, and the extent of the rotation, the extreme of the rotation, would be the 1415 area. As always, you can always go back and look at the prior day's trader bite and see what happened versus what was discussed. I encourage you to do that after the market closes as part of your homework, and see what went wrong. And during these today's trader bite, after the session is done, I usually go over what was expected versus what happened and how we adjust for that if we need to. But the expectation was for responsive buying, to find sellers at some point in this gap zone, and then the expectation is for it to rotate down to 1890. What ended up happening is that we did not find any buyers at all on the open yesterday. So if I zoom out and look at the trigger chart and look at the open, we'll notice that the open was an OTD, or an open test drive. It made a very, very feeble attempt at pushing higher. This open can also be classified as an open rejection reverse, but it did make an attempt higher, and then the big rotation, the bigger rotation down took place right away, and then we had the pullback to the mid. This was a setup right here, pull back to the mid, and then the continuation. The continuation is larger than the initial impulsive move, so this move here was larger than this move, and so you expect further continuation and so on and so forth per plan. The first rotation back to the mid, again, a successful setup there, and a rotation. The expectation is for it to break the IB low. Did not break the IB low, put in a double IB low, pushed again, did not quite get to the mid, and then as soon as it started to rotate down, the expectation is the double IB low would break. The probability of a double IB low breaking is in the 83% range. Again, past performance, not indicative of future results. Once it pushed through the 88 down to the 86.75, so 5 ticks, it found buyers, and it found strong buyers at that point. It broke through the mid, so now the short bias is off. There was an awful lot of liquidity here. I posted a chart. You might want to look through the Twitter feed. I posted a chart of my S5 book map showing the liquidity below and how the market treated it, and especially how it treated it on the way back. The liquidity was at 92.50. It created an opportunity for this 92.50 short for the continuation. That was a pretty classic setup there. But once we pushed through the liquidity, and then from the top and through, and then came back up through it, I started to send out a caution shorts in the S5 chat room, and then we got this push up a fair amount of time later, about an hour later. It just took forever. And then from that point on, we're looking to the top side, and we're looking for a neutral day once that happened. Once it started eating into into that day's initial stem, it became obvious that we needed to back off of the short side. And as I scroll forward here, you'll see how it just took off. I mean, that was a really big short squeeze there. Some really strong rotations, 9.25 without a single 6-tick pullback, and then from the bottom here at 89.50 to 19.08. A pretty good 20-point rotation, basically, all the way up. And then the way the market closed, when we see how the market closed, it essentially closed right at the top, making this a very, very strong push. This is a neutral day, and having closed at the top like it did, it's what we call a neutral extreme day, and these are usually reversal days, and this kind of day usually pretends that the overnight session will continue higher. When the market closes near highs, we couldn't shift the point of control up. That would have given it even more strength if we had shifted the point of control up. But in any case, we broke the IB low, we broke the IB high, we finished on the extreme. This is an extremely neutral extreme day, which means that we expect strength into today. So my bias this morning is to the long side. I'm going to be looking for areas to push against liquidity, buying liquidity to get long and look for the continuation. The overnight high is expected to be vulnerable, and I'm looking for it to take out that 1940, 1943.75 again. So that's how yesterday played out. The only thing with the primary hypo that didn't play is we did not get the responsive buying. We did get our target at 1890. It was tough to get on. At first, we did have a couple of 50% or midpoint pullbacks that allowed us to get on, and so it's all good there. But for now, the way things are shaping up is that we are pushing through, and we're likely to target the high volume node we left behind from a couple days ago from the Monday. Monday was a very, very tight day. You could see that there's a balanced profile here with the point of controls yet untouched, and the point of control is just a tick or two above the overnight high. It's no coincidence that the overnight high was there where it found liquidity and fell off. Before it pulled back to the 1930 again, and has been chopping around in this 1930 in the overnight session. So the expectation is that this point of control will likely to be a magnet. We are above this low volume node. The key low volume nodes on this profile, on this MC, are 31 and 98. And as long as we stay above the 31, we're likely to get this 39, and then once we get to 39, we're likely to chop, and then I'm looking for the continuation higher. I would caution shorts today. That's the primary hypothesis. Now, anything can happen. Let me just be clear. As I said yesterday, I don't have the power to predict what the market does. That is not what trading is about. We would all love to be able to predict what the market is going to do, and just bet the maximum size allowable and just always bet in that direction. But the fact is, every trade has a 50-50 outcome. Every single trade, no matter how good a plan you have, has a 50-50 outcome. The combination of your trades has hopefully an edge. But overall, the market will do what it wants to do. The idea is to take the context of what we're after, and the general idea, and align ourselves with it. Wait for the market to align itself with it, and then align ourselves with it to surf that wave when it happens. So the thought is that it isn't going to hit the exact expected price. It's an illusion to think that the market has to go to this particular price, then turn at this particular price, and then go over here and do this, that, and the other thing. That is not the idea. The idea is we work in zones, and the market can push, and it can always get buyers that are early. It can always get buyers that are late, or sellers that are early or late. We just don't know. The idea is not to lose yourself in the action and start trading against your plan. And that's the key here. And you notice that the process is consistent on a day-to-day basis. Anyway, I've gone over my time. That's the primary hypothesis. The secondary hypothesis is it pushes up to 1939, takes out the overnight low, and finds its sellers and starts to rotate back down, in which case the target below, the initial target below, would be the MC. Sorry about that. The initial target below would be the MC point of control, which is at the 23 area, and then if it cannot hold the MC, then it's likely to target this 98 area, and we're back to 1900, taking back most of what we did yesterday. That's your second hypothesis. Hopefully you're finding this helpful. Hopefully you're finding that the repetitive process that we're following here on a daily basis is helping you create a more solid plan to trade again. You have to keep a flexible mind, and you always have to take what the market says for what it is, rather than what you want it to say. Good luck, and I'll catch you tomorrow. Take care.